Good evening, ladies and gentlemen. I welcome you all to the Q1 FY23 post-earnings conference call of Royal Orchid Hotels Limited. Today from the management we have with us Mr. Chandra Balji, Chairman and Managing Director, Mr. Amit Jaiswal, Chief Financial Officer, and Mr. Prashant Mehrotra, Chief Operating Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which exemplifies our judgment and further expectations concerning the developments in our business. These forward-looking statements involve risks and uncertainties that may cause actual developments and results to differ materially from our expectations. Also, this is a reminder that this call is being recorded. I would now like to hand over the floor to Mr. Chandra Balji, Chairman and Managing Director, to give his opening remarks, post which we will open the floor for Q&A. Over to you, sir.
Good evening and warm welcome to everyone. Thank you for joining us for the Royal Orchid Hotels Limited earnings conference call for the first quarter of financial year 22-23. Please note that Q1 for year 23 quarter results, press release and investor presentation are available on the exchanges. I hope you had the opportunity to browse through the highlights of the performance. Last 2 years have been very tough for our industry. We have sailed through these turbulent times very successfully. The industry was coming into normalcy from November 21 onward, when the third wave of Omicron hit us in January 2022. But we recovered from the third wave quickly and bounced back in March 22. From April 22 onward, we have done robust business, which is evident from the financial results of the first quarter. We have learnt a lot during the last 2 years of how to be pragmatic in difficult times and how to control the cost of our operations. And the benefit of our learning is visible in the present quarterly result. The company has posted robust growth because of strong business model and effective risk mitigation strategy. As our business bounces back to normalcy, we are aiming to post better margins than what our company has witnessed in the recent past. The first quarter results have been one of the best in the last 10 years. Financial highlights of the company the first quarter ended 30th June 22 on a consolidated basis are as follows. Revenues from operations for Q1 was 60 crores as compared to 39.53 crores in Q1 22, which is a growth of 53%. This is attributed to the increase in ARR and occupancy and increase in F&B business. EBITDA for Q1 was 24 crores as compared to 14.24 crores in Q1 22, an increase of 69%. EBITDA margins stood at 40%. PAT before exceptional items for Q1 stood at 11.53 crores as compared to 4.93 crores of Q1 22, an increase of 134%. During the quarter, we've been able to increase the average room rate from Q1 23, it stood at 4,880 as compared to 2,769 for Q1 22, a growth of 76%. During last year, we had opened 9 hotels with 388 keys, and the first quarter we've opened 2 hotels, taking our total tally to 73 hotels with 4,546 keys. We're well in line with our vision to operate 100 hotels by 2023 and are looking forward to opening new hotels in different cities of India. During the quarter, we witnessed RevPAR growth led by higher ARR. We believe the industry has seen a revival and we have bounced back with better results in the current financial year. The management has set out a strategy to diversify its products, provide unique customer experience, and work towards a robust balance sheet. I would like to conclude my opening remarks by saying that we are witnessing major signs of revival for the industry as a whole, which will show up in our overall earnings quality over the next several quarters. Thank you, and now we can throw the floor open for questions.
Thank you, Mr. Balji. Participants who wish to ask a question may kindly use the option of raise hand, post which we'll be inviting you to ask your questions. Somebody has unmuted, you may go ahead. So you unmuted your line, 1+ KP 2001, if you can announce your name. Orchid Singhal, you may go ahead, please.
Yeah, hi. Thanks for taking my questions. Sir, firstly, wanted to understand what is the current occupancy and pricing versus the pre-COVID levels? And do you think this current occupancy and pricing will further improve as we progress in FY23?
Yeah, there has been a phenomenal rise in the occupancy as well as the ARR. See, currently we are operating our hotels at around 78% occupancy, and the average increase ARR also around, from the last year same quarter, if you compare, there is a robust growth of roughly around 60%, 60 to 70%. Growth is there in different hotels as far as the ARRs and occupancy is concerned. Occupancy, of course, around 80%. I think going beyond 80% becomes a little difficult. But ARR, there is a scope for another 10-15% increase in the ARR, which we are very confident of having in the quarters to come.
Understood. Thanks for this. And secondly, looking at the EBITDA margin for the standalone entity versus the subsidiaries, it looks like the subsidiaries are making a lower margin versus the standalone entity. So what is the strategy here to improve the profitability of subsidiaries? And I mean, I also saw FY21 annual report, so there were a couple of subsidiaries which are loss-making, like Icon Hospitality, Sheer Sagar, Maruti Comfort. So if you can highlight, like, what is the strategy to make them profitable?
See, as far as Sheer Sagar, that is our Jaipur hotel, and Icon Central Bangalore, these are the two hotels which are little drag as far as subsidy is concerned. But Maruti and the Goa hotel will definitely make more profits in time to come. And Jaipur hotel is a little seasonal, it's a seasonal hotel because the first quarter historically doesn't do that much great performance, being the summer is there in Jaipur. But in the last 2 quarters, it will definitely bounce back and do very well.
So we expect an overall improvement in margins going forward, right? From 1Q levels?
Yes.
Okay. And sir, last question from my side. So 1Q we saw 60 crore revenue. Where does the company aim to be, let's say, in 3 years from now in terms of any revenue ambitions you have?
See, revenue ambition, let me tell you, there will be a little organic growth as well as inorganic growth. And we are trying to take the revenues to maybe in 3 years' time to say around 400 crores.
So just one clarification here. So you mentioned about inorganic growth. So if you can highlight more, like what you are planning here, is it going to be asset light model or asset heavy model?
No, definitely it will be an asset light model because by inorganic growth I meant that, see, we are taking more and more hotels on management, where the management fees straight away goes to our top line and bottom line. But simultaneously we are also trying to sign hotels on revenue share basis also. So these are the two strategy where a lot of investment is not required. Rev share, there are marginal security deposit investment. Management, there's no investment at all required. So that these are the two ways which we will grow. And of course, getting asset right now we are not looking at.
Great. This helps. Thanks a lot for answering my questions and all the best for future.
Thank you.
Thank you, Orchid. We'll take the next question from Yash Agarwal. Yash, you may unmute and ask your question.
Yeah, good evening, sir. Congrats on a good set of numbers. I had a few questions. So, large part of our hotels is managed and franchisee hotels. I just wanted to understand how does the revenue and cost recognition work here? I'm a little new to the company. So if you could just explain, how the revenue and cost recognition works in the managed hotels, for you.
See, as far as cost is concerned, we already have a fixed cost across our company, whereas the corporate expenses are almost fixed. However, say for every 10 hotels, we may add a cluster head or a AVP level person to provide support to the newer hotel. So I think the revenue growth will be substantially higher than the cost growth because most of the fixed costs are already there. So that is how we are going to work in future and try to limit our. We have learned a lot in COVID of controlling costs, and we have already done it. And so we are a very lean and mean kind of an organization today. And this is how we are going to grow in the future.
So, sir, actually, thank you for the answer, sir. My question was more that suppose if I have 5 managed hotels, so all of those revenues and costs are accounted for in our profit loss statement, or do we only account for some bit of, commission income? Or how does the recognition work for us?
We account only for our fee, which will come to us. We charge a fee to the company, which is usually around aggregate of about 6% of the turnover. That's the fee we'll charge them. So that will come to our this thing. Costs and other things, the revenue will all be on the owner's account. It doesn't reflect in our balance sheet.
Sure. And sir, is there any initial, suppose whenever we sign up a managed hotel, is there any renovation expense or something that we have to do, or it's all on the owners?
All on the owners. Managed properties, all expenses are the owners.
So incrementally, the hotels that we are adding, I think 12 to 13 hotels that you mentioned in the presentation, are they most on the managed basis, sir, or they are on
Yeah, they're mostly on managed basis. They'll be going forward. Maybe about 10% of the hotel will be on revenue share, where the costs and revenue will come onto our books.
So out of the 60 crores, could you outline how much of the revenue is from the managed hotels?
See, from the managed hotel, roughly, as far as revenue is concerned, so they contribute roughly 20% of the revenue.
So about 12 to 15 crores or 10 to 15 crores. That's the right assessment?
Yes.
And the margins on this will be extremely high, right? Because this is completely flowing into EBITDA for us.
No, margins are quite high as far as the fees are concerned. But we have a certain fixed cost of, managing these managed hotels. There are basic cost of the sales offices and blah, blah things. So, but yes, of course, the margins are high. And as we add more and more hotels, the margins will further grow.
Okay. So on the questions of, previous participant question of the occupancy and ARR, so has that improved further from the first quarter, or is there some bit of cool down in terms of seasonality? And how do you expect this to?
We have maintained the run rate of occupancy in the current quarter also, and there is marginal growth in the ARRs also.
Got it. So, one final question from my side. What is the net debt of the company, gross and net debt?
The net debt of the on consolidated basis is around 88 CR.
88 crores. Oh, okay, sir. And sir, suppose if you want to meet on a separate basis, on a one-on-one basis, how can we do that? Because
you can get in touch you can get in touch with Mr. Vinay Pandit, who's there on the line. He will take it forward.
Oh, okay. Thank you.
Thanks, Yash. We'll take the next question from Darshil Zaveri. Darshil, you may unmute and ask.
Hello, sir. Am I audible?
Yes.
Yeah, so congratulations on a brilliant set of numbers, sir. So I just wanted to ask, so because I think Q3 and Q4 might be even better numbers. So could you give any guidance in terms of what revenue do we expect by FY23 end? As you have already said, margins will improve. So could you just give some
Sir, revenue, we should be able to touch around 280 CR for the current financial year.
Maybe a little better.
Little better also.
Normally, the first 2 quarters will give about 40% of the revenue, and the second 2 quarters give about 60%. It may vary a little up and down, but if we extrapolate what we have already achieved of 60 crores, then 4 times that is, 240 crores. But we do expect 280 to more than 280 crores. Because some hotels are also likely to come into the pipeline. So our target is to cross 300 crores.
Yeah, so that's amazing, sir. And the margins will keep on increasing because
Yes.
we have. So, sir, would it be fair to assume we'll do more than 40-45% margin?
Not 45% is not possible in our industry.
Oh, sorry,
So, but it will be around 40% definitely.
okay.
EBITDA.
Yeah, sir, EBITDA, sir. And sir, just my one last question, sir. Any risks that we see that might, we might just face, or some problems that we might face, except the pandemic, because the slowdown, recession, do we have any fears, anything?
Not really. See, we can't predict into the future like pandemic was not predicted. I don't visualize any other major risk in our business.
Okay. Thank you so much, sir, and all the best for future numbers, sir. Thank you so much, sir, for your answers.
Thanks, Darshil. We'll take the next question from the line of Rahul. Rahul, you can unmute and ask your question.
Thank you for taking my question, sir. And first of all, congratulations on a great set of numbers. Sir, you have always given a broad outline of trying to reach 100 hotel properties. Given your already existing ones and the pipeline that you have shared in the presentation, you will already be touching about 90. So 100 is literally not far away. So what is the next phase that we are looking at beyond 100?
Yeah, actually, particularly in management contract space, the growth is exponential. So if this year, I would say the next 1 year, we are able to reach 100, then definitely, you can easily add about 30 to 40 properties in another year or so. I think that should be it is the target, and only hope, because sometimes, in opening hotels, the circumstances beyond our control, because the owner is controlling and driving the project.
Right.
And he may have some funds constraints, or he may have some organizational constraints, which is why he's not able to deliver also. So, but then we do provide support to him and guidance of how to execute the project. Certain people take the guidance, certain don't.
Okay. So secondly, given the uptick in the industry and the profitability that we have reported and the continued profitability, we should expect, by the year end pretty much being close to a net debt free kind of a situation, or what do we plan to do with all the cash flows that we are going to generate?
You see, with what like Amit had also mentioned, that we are getting into some revenue share deals also. We are actively looking at for revenue share deals where there will be some working capital requirement. That means we'll be requiring money to pay the deposit. We'll require money to start up the hotel. Some operating supplies we have to give. So I think it'll be a combination of both. We will reduce our debt to some extent, and the balance money we will deploy for getting the more revenue share hotels.
Okay. So just third update, is there any further asset or something that you can monetize? Last we heard you had something in Africa as well. Anything that you can kind of monetize that is left to be monetized on the books?
See, Africa debt has been in the market. The market there was quite depressed. But now I am told that the market is picked up because there's been a change of government and change of heart. They're actively inviting investors. So I'm told that the area is developing. And the moment the area develops, then obviously, then we will get buyers. And I'm planning to visit Africa this month so that to try and meet some prospective investors and all that. And but at the moment, since there's no distress in the company, so we don't want to, be in a tearing hurry, having waited patiently for so many years. We will go there and we'll try to explore and try to monetize the asset within this financial year.
Great, sir. Lastly, I don't have a question, it's a suggestion. In the presentation, sir, in quite a few of the slides, it's basically a comparison between Q1 FY22 and Q1 FY21. There is and I am assuming it's a comparison between 23 and 22, but a lot of places just mention 21 and 22. It's a little confusing if that could be corrected. Thank you very much.
All right.
Thanks, Rahul. We take the next question from Rishikesh.
Hi, sir. Good evening. So my first question is, I need a clarification on the EBITDA margins that you said for FY23. So did you say like 40% for whole year FY23?
Yes.
Okay, and that is on standalone or console basis?
Console basis.
Okay, great. So my second question is, how much cash and investments do we have?
See, we have, if you really look at our balance sheet, even 31st March balance sheet, if you see, roughly around 30 crore cash we have.
Right, and also you have some 25 crores investments, right?
Yes.
Okay, so what is the plan, sir, with that cash and investments? What exactly are we going to do?
See, as Mr. Baji rightly said, there are two ways of handling the cash. One, we use the cash for the growth of the company, or second, you retire your liabilities, right? So we will try to balance it out, because now is the opportunity to grow the company. We have to keep it in mind next 5 or 10 years of performance, what we are going to do. That we need to decide now. So that is why we will use it very judiciously, that the cash what we are having as well as the income which is going to come during the year, so that we can plan the company's performance for next 5 or 10 years.
Okay, so your gross debt, if I see, it's around 150 crores.
No. Debt is not 150 crores. Debt is only 86 point something crores.
Okay.
87 crores. Yeah.
Okay, so are we looking to be debt free in near term?
The debt is been distributed into 3 entities. The one is the standalone, which is around 40, and then one subsidiary of 20, and then another subsidiary where we have around, around 30. So that is how it has been distributed. So subsidiaries where we have partners, I don't think so much can be done. But standalone, yes, we are looking, if not full, at least, part of it we may retire. It depends on the opportunities what we get. Now there is a lot of opportunities in the market to sign some revenue share, as Mr. Baji has said earlier. So that will pave the path for the company's growth in time to come. Okay. And believe me, the debt is at a very low cost. It is at a very, very low cost of around 8% and odd. So that is not hitting us so badly.
Okay, great, sir. Thank you very much.
Thanks, Rishikesh. We'll take the next question from the line of Rajesh Agarwal. Rajesh?
Congratulations for good set of numbers. See, my small question is, what has led to increase in employees' benefit expenses? 20% it has gone up quarter over quarter.
See, when the business goes up, we were working on a very, very low staff because of the COVID situation. There was a salary cut also of some of the employees. Now, all salaries have been restored, and more people, naturally, if the business goes up, you need more people. So more people have been employed. So with the result that salary has gone up, and of course will go up in future also. But we are watchful of the situation that it should not go up to those numbers which are pre-COVID levels. We're trying to keep that under control.
Rajesh?
Yeah, because quarter over quarter 20% increase, unless salaries have been revised or more people have been inducted. Normally, other companies, we have been finding that the salary employee benefit structure has remained same quarter over quarter.
No, Mr. Agarwal, please understand, our industry is a very employee-intensive industry. So if you see in the last quarter, January was literally, third wave was there. And we managed to close the quarter with as the least employee. But with, from April onward, most of our hotels are doing 80% occupancy and a lot of F&B business. So we had to increase the number of employees. That is why you are seeing the jump in the numbers. But this jump now will not go every quarter. It was one shift from one year to another year. So this cost is not going to go up in every quarter. It was a one-time exercise when we were doing 50-60% occupancy. All of a sudden it has gone to 80%. So we had to increase the number of soldiers on the floor.
Understood. Very well. Because induction is there more, so hence this cost increase.
Yes.
Could you throw some light on our Goa hotel? Now, how it has performed on 100% basis, top line and bottom line?
See, the Goa, I will just let you know, the Goa hotel has performed very well in the first quarter. Okay, and it continues to perform very well. That was the reason why we had taken the 100% stake of the Goa hotel. In the first quarter, they have done 89% occupancy.
YouTube.
And they have shown a phenomenal growth in the ARRs also.
Mr. Amit, one question which is a little distinct. What is our total contribution coming from our Bangalore center? We have around Bangalore. What is the revenue share of the total revenue? We have 8 properties there. 4 are owned, leased, and subsidiaries.
Yes.
So what contribution it gives to 60 crores? 60 crores.
To 60 crores, no?
Yeah.
I will just tell you. Okay, I'll just get back to you.
Yeah, please, no problem. Yeah, thank you. Thanks a lot. Again, congratulations.
Thank you.
Thank you, Rajesh. Anybody else who wishes to ask a question, we use the option of raise hand. In case there's a problem of raising hand, you can unmute and ask your question. So one question from my side, if you permit.
Yeah.
Could you give investors some light on this plan to add 17 hotels and 1,000 keys by 2023? And by what route, management, operator route, or own properties, how would this be?
These are mostly managed properties. There will be 1 or 2 out of the 17 which are revenue share. And most likely this financial year, they should begin. Out of that, maybe 1 or 2 property may not come up in case there's a inordinate delay in completion of the project. But then to compensate for that, our development team is aggressively working on adding more properties. So there may be some properties which are already ready to operate properties which will come into the system. So I think we are aggressively working towards the target of 100 hotels. Well, I just hope that we will be able to achieve it. Our development team, our operation teams are all getting geared up for that.
And this is a target for end of FY24, right?
No.
Or
Much earlier, 1 year from now.
okay.
44% of the revenue comes from the Bangalore market.
How much?
44%.
44. Thank you.
We take the next question from Anupama. Anupama, you can unmute and ask.
Yeah, congratulations for the great numbers. I just wanted to understand if you can give us a breakup of managed and owned hotel contribution, revenue contribution. Managed you have given us.
Around 19% of the revenue comes from the management.
And the owned ones?
Balance is owned ones, around 81%.
Okay, balance is owned ones. Okay, thank you so much.
So can you also throw some light on the travel trends that you're seeing since you have multiple properties across regions?
I request Mr. Malhotra.
Hey everyone. So right now in terms of travel trends, we see a very, very robust trend coming out where the corporate demand has also picked up as well as leisure demand continues to grow. And in the last quarter, we also saw a lot of weddings happening at the hotels, which we foresee in the future. To the question, if we look at the demography, I think so 94% to 95% of our customers are domestic Indian customers who've been staying with us. So it's largely a domestic consumption story is what we are witnessing as a pattern. And going forward, we see this pattern continuing. And as international guests start coming into India, we see a very, very robust travel environment unfolding. Also, with the government of India planning many new airports, with the new highways getting connected, it's going to be a very, very successful story as we see forward.
Yeah, I see a large amount of business coming in the long weekend. India celebrates so many festivals. And so if there is a Tuesday there's a festival and it's a Saturday, Sunday holiday, people will take Monday as one casual leave and have a 4-day weekend. So that has seen a growth tremendously because it's easy to book. You know, on the portals, you can just sitting down in 2 minutes, you can get a confirmation. The rates are pretty much competitive and flights are easily available. So I think that has been a huge growth in the last year or so. The long weekend business, people instead of taking long annual holidays are taking 3 or 4 shorter holidays. And that has definitely benefited us.
Okay. So as of Q1, your average occupancy is at around 68-78%, depending on managed properties. And average room rates have hovered around 5,000 owned and leased properties and around 3,700 for your managed properties.
Right.
Do you see this trend for this year and next year? The new properties as well coming in.
Pretty much a similar trend because you see in managed properties you'll find that some of the properties, in the owned are like 5-star properties. Managed hotels are not 5-star. So I think, and also, when a management comes up, it takes some time for it to stabilize. So they will be at any particular moment of time, there will be about 10% properties which are not yet stabilized and their ARs are low. So, but eventually this segment will grow quite exponentially as compared to the other segments. So I think, whatever you're saying in terms of turnover, that will grow probably much faster than the owned properties because we're not adding any owned properties, we're adding only the managed property.
Okay. We'll take a follow-up question from Rahul. Rahul, you can unmute.
Thank you, sir. We'd already mentioned that because of the pandemic last 2 years, probably the number of offers that you would have got to sign up for, let's say, a managed contract or whatever would have been higher. What is the situation for, let's say, if somebody wants to put up a new project? It is now getting incrementally more difficult than it was pre-COVID. What is the situation there? Are banks ready to fund?
I think there is no difficulty. It's just that managed space also is having competition. There are a lot of people who are starting management companies.
Right.
A lot of them we are exiting management companies because management companies works on a very wafer thin margins. The strength that we have is that we have our own properties, which even if the managed properties did not perform well, our company has the wherewithal to stand to afford the overheads required for the management company. So we are pretty well placed that way.
Let me rephrase the first question. If today, hypothetically, you wanted to kind of start up a new project, a 4-star or a 5-star hotel, what are the kind of timelines we are looking at?
A greenfield project will take 3 years minimum to set up. And because the standards are not improved in our country, it takes maybe 3 to 4 years to put up. And depending on which city you are in and how proactive the government sanctions are. So that is why we have refrained from taking up any greenfield projects, because it's a long process, and then you have to have the bank loans, you have to have working capital requirement, you have project costs. So we are staying away from that at present.
And are you seeing others kind of being active in that segment, greenfield expansion?
Well, everybody, see, whatever you see the new trend, everybody will follow that. Established hotel companies are also getting into management contracts and all that.
Okay.
There will be, definitely more competition, but then there's no fun without competition. We are there to take it on.
Sure, sir. Thank you. Thank you so much.
Thank you, Rahul. Anybody else who wishes to ask a question? So since there are no further questions, would you like to give some closing comments before we end the call?
Yeah, I see. As I think most questions have been answered, to say that in this we have survived, and a lot of management companies have actually closed shop because we ran most of the hotels. And I would say the credit goes to all my team. I'd like to thank them for the support, because without their sacrifice of doing double the work and half the salary, they all stood by us. And that's why this company has become much stronger than it was. And our pipeline is growing pretty fast. And also our image in the market has improved a lot. We are a very well-known brand today. At one time, we used to struggle to contact people and to be talked to, and now a lot of people contact us and at least consider us for the management contracts. So I think going forward, to my mind, I'm very optimistic of the future, and we look forward to meeting all of your expectations this year and the coming at least 2 years. I can't give you prediction for 5 years, but at least I'm looking at a very, very robust next 3 years. Thank you very much.
Mr. Vinay, you have to unmute yourself.
Vinay, you're mute.
Thank you so much, sir. On behalf of Captify, I thank all participants for joining us on this call. And I would like to thank the management for giving us their valuable time. Thank you so much.
Thank you. Thank you, everybody.